Hey, thanks for making it to Veterans Info Tap. I'm glad you made it today. Today I wanted to talk to you about 25% more of compensation, at least on paper. This is a really important thing that if people don't understand it, you might miss out on some tremendous opportunities. So with that, I want to get into kind of the meat and potatoes of what this looks like. So please hit the thumbs up for me, subscribe, share with a friend, all that good stuff. The great thing about VA compensation, pension, DIC, and really even the school benefits, and that's a little bit of a different animal, but any of the tax-free pieces of benefits that we receive, monetary benefits, is tax-free. So when you go to apply for any sort of loan, whether it's a personal loan, a car loan, a mortgage, a home equity line, whatever you're looking for, you are going to be in a better position, a better buying position if you have a lower debt to income ratio, which means the higher your income versus your total debts, right? So the more that you can increase your income, the better. And this is where VA compensation and all the others like pension and DIC and so forth come into play. Yes, we get a monthly payment. That payment is not taxed. However, when institutions are asking you what is your gross monthly or annual income, that is not equated into our VA benefits payments, right? So you may give a gross number for your employment. We'll just say that you have W-2, right? So you give your gross payment, total money on your W-2 or annual income or your monthly income or whatever it is from your W-2 pay, and then you have your VA compensation or DIC or pension or anything like that, and you need to do something called grossing it up, and that is taking that total amount and multiplying it by 125% to effectively create a grossed dollar amount, of which then it would be taxed theoretically, and then it would leave you with your net amount, which is the amount that you actually receive from the VA. So an example would be, let's say you're receiving $1,000 a month. You have that $1,000 a month tax-free. You go in to buy a car or whatever, you need to tell them that it's $1,250, right? Or if it's $4,000, then it's going to be $5,000 per month. Okay, that's a big difference, especially when the numbers get bigger and all that stuff. So whether you're, again, looking to buy a house, buy a car, get a personal loan, anything like that, you need to make sure that the lender is using the correct numbers. If you just give them your net amount, the amount that you receive from the VA, then that's the number they're going to work with. You need to give them the larger amount, the plus 25%, and then you can write a little letter explaining that, hey, look, this is tax-free money, blah, 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 and this is my net amount that I receive every month. It's not taxed, so grossing it up takes it to 125. Now, some good lenders out there that deal with military clients will already understand this and do this and not have any issue. But if you're working with a smaller place or there's not a big military presence there and it's a smaller institution that you're working with, they may not understand or know to do this. So make sure that you're taking care of this up front for yourself. Now, the other piece to this is when you're looking at either school benefits, so whether it's Chapter 35 or if it's post 9/11 GI Bill, whatever it is, those are also tax-free. You can gross them up, but here's where the issue may lie, depending on the type of loan or whatever you're looking for is, right? So whether it's a house or a car or a boat or a personal loan to do home improvements or whatever, oftentimes, if it's in the house world, so you're doing a home equity line or a mortgage, they may want to see a minimum of a 3 years continuance of that specific benefit. So sometimes those won't really help you in the big picture as far as debt to income ratio is concerned, but the underwriters on those types of loans will look at that and consider it as kind of in a collateral way. So sort of like a collateral effect of everything, and they'll look at that as as an additional positive for you. So it'll help kind of offset something else that may be negative. So it's a good thing to disclose it. It's just that it might not be used for actual income for the qualifying purposes. So just important to note on the school stuff, anything that's like shorter term or temporary 100% obviously is not going to last for 3 years. Now, for shorter term things, they may not care, right? So if you're getting a car loan or a personal loan, they may not care about that stipulation of a 3-year continuance. Now, another kind of thing to think about is when you're proving income, typically, they're all different, and credit scores will kind of change things too. If you have a really high credit score, they may not require much of you at all. It's just you say it and it magically happens. If your credit score is okay, or if it's a little on the low side, they may want more documentation, right? So in any case, no matter what you're doing, if they are requiring documentation regarding your income, normally what happens is they want 2 forms, 2 ways to prove your income from each source. So if you have, let's say, a W-2 job, well, then that's going to be pay stubs and W-2s. So that's the 2 ways, right? Now, with VA compensation or school benefits or anything like that, we do not have a pay stub from them. So the way that we would end up doing it would be award letter, and in addition to the award letter for compensation, let's say, or DIC or pension, here's the award letter. Then, in addition to the award letter, we would have to get bank statements. Now, in some cases, it may only be 1 bank statement to show the direct deposit with that amount, matching the amount on the award letter. In other cases, they may want 3 months worth. And just to kind of throw this out there as kind of another little extra, nugget, just because we're on this topic, if you are looking to do a big purchase, like a home purchase, for example, and you need to have X dollars in the bank in order to make this transaction happen, oftentimes they're going to want to see at least 2 months of that money being what they call seasoned. So if you needed to get some money from somewhere, other avenues, and get that into your bank, you're going to want to let that kind of marinate and be there and season before it can actually be utilized. If you just plop whatever it is, $50,000 into a bank account tomorrow, and then a week from now you go apply for a loan and you give them your bank statements in a month from now and they look and they see that big deposit, they're going to ask you, where did that come from, and show me the paper trail so they can make sure that you don't owe a payment on that. So in other words, what they don't want to see is you went out and borrowed $50,000, dumped it in your bank account, and now you have a, whatever it is, $1,000 payment on that $50,000. Now they have to equate that $1,000 somewhere, right? So now that's part of your debt. So that affects your debt to income ratio. Now, that's why they allow that 2 months to make sure that if you did get a loan, that it does show up on your credit report, so that way they will see that the payments are there, right? So, or on the other hand, the $50,000 is there, a couple months goes by, it's still there, they don't have any issues with seasoning. Then what happens is they look on your credit report, there's nothing there regarding a loan, so they assume at that point that you've just saved, right? You saved whatever, $1,000 a month for the last 50 months. Now you got 50 grand. So that's kind of how that stuff works. Just wanted to share that information and let you know the importance of being able to gross up your not taxable VA benefits and how important it can be. So with that, thanks so much for watching and have a great one. And remember, if we don't take care of each other, something went wrong.